Hey, Victor. Welcome back to another episode of the Beckonomics podcast. We're talking about inflation today. And from a kind of new perspective from what we've done in the past, I think is really interesting to kind of taking a look at not only how do financial markets view inflation in the Fed, but also how does it affect consumers and what does it look like through the consumer lens where inflation is part of your everyday life and really has complicated, the budgets of a lot of people recently.
Yeah, I think there's a really interesting dichotomy between how Main Street, the typical US consumer, views inflation and how Wall Street views it through this lens of, hey, what's the latest inflation print been? How is this going to, impact the Fed's decision making when it comes to rate cuts or rate hikes? I think Wall Street's a little bit myopically concerned with how the Fed is going to act right now, whereas consumers are really feeling that impact of inflation over the last 4 years. We're going to get into some of the statistics later, but it's pretty amazing seeing just how much prices have risen since, your pre-COVID period. And but first, I kind of want to talk about why do we pay so much attention to inflation? Why does it matter? Why shouldn't inflation just be zero and we just keep prices the same? So first, I'll talk about maybe why inflation is a little bit good. You can talk about why it's bad, like right now. But the market can appreciate, and the U.S. consumer can appreciate a little bit of inflation. Just because, and this is where the Fed's 2% target kind of comes from, just enough to grow the economy. You want your wages to grow on a regular basis. With zero inflation, you're talking about making the same amount of money essentially every year. If that's not just naturally growing. And then also it incentivizes businesses. If your dollars 10 years from now are not going to be worth what they're worth today, it incentivizes them to invest in capital projects in order to grow their business, to make more money. Because if it's just sitting in the bank making nothing, it's going to erode away in value. Because if you have 20% inflation over the course of 10 years, that dollar is only worth, roughly 80 cents by the end of those 10 years versus what it's worth today. So what you want is to incentivize companies and consumers to invest in projects or invest in markets or in assets in order to grow that wealth so that it continues to be worth more on a inflation adjusted basis. And then the other kind of benefit, of course, is whenever you're taking on debt, the majority of US debt is fixed rate when it comes especially to the consumer. Think about mortgage prices or your car loan being the biggest of those two. If you're taking out fixed rate debt, you're paying back cheaper dollars in the future if there's at least some form of inflation than you are whenever you took out that loan. So the $1,000 a month that you may be paying now, down the road, it's the equivalent of, maybe $900 a month that you would be paying in the future. So it does make that debt a little bit easier on the consumer. But as we've seen, especially recently, there's a lot of downsides when you have too much inflation. And so I'd love for you to walk through that a little bit.
Yeah. So, starting with the big one is it just really screws up people's finances. If wages don't keep up, it makes the everyday items that we want and need to survive, that much more expensive and harder to afford. This particularly can be seen with retirees who might be living off of Social Security or pensions that don't always keep up with inflation. Social Security is pegged to inflation, so they do adjust that up. However, as we've seen across all different item buckets, inflation acts differently across all of them. So, retirees who might be facing much higher, healthcare costs than the average American, well, they might be adversely affected by that inflation, but only get compensated for overall headline inflation that includes new cars and trucks that they're probably not buying. So really hurts retirees and people with like more fixed budgets, especially people who are working still whose wages aren't keeping up with that. And then additionally, as you mentioned, with businesses being incentivized to invest in projects, it can hurt people who are saving into savings accounts and stuff, and they're working and putting away a certain number of dollars every year, every month. But if those aren't keeping pace with inflation, the employee can't necessarily go and start their own business at the same time to reinvest those dollars. And so if they're just sitting in even a high yield savings account, oftentimes they're not keeping up with inflation. So, which kind of goes back to the importance of being invested in markets, equities providing a really good hedge for inflation, as well as some other products, but we'll talk about those a little bit later, like how consumers can kind of protect themselves from this erosion of purchasing power, but it can really hurt people who are just trying to save up for retirement. And then finally, I want to touch on real quick, it hurts banks a lot because they're the ones providing all of this financing, and that's getting eroded away by inflation. And as we saw in March of last year, it can, whenever push comes to shove, rates rise a lot, it can really pinch them, both from the Fed perspective, but also just from the inflation perspective.
Yeah, definitely. And I think you made a really good point about the consumer there, talking about a lot of that, to benefit from inflation kind of eroding the cost of one's debt, specifically a mortgage. It's not helping those individuals who don't own a home yet. And so if you don't own your home, what you're seeing is that home prices are increasing due to inflation, but you're not getting the benefits of either owning the home and having that increase in value, or the benefit of the mortgage becoming less expensive because the dollars you're using to pay are cheaper now. And so it's really hard on that early consumer who doesn't quite, own a home yet, who's looking to potentially purchase a home. Both home prices are going up and they aren't benefiting from the lower cost of that debt. So it's kind of putting them in this situation that's a little bit precarious. And that's why the consumer is hurting so much. And what we are really attuned to is the health of that consumer. And a big reason why we aren't currently super invested in consumer discretionary companies right now is because that relies on consumers having adequate dollars, discretionary dollars to go spend at places. And the thing is, they're getting pinched by inflation at the grocery store, at their fundamental costs, whether that's the cars, their automobiles. The automobile insurance is up 46% since 2020. Just inflation across the board is up 20% since 2020. And so if you're looking at what cost you $1 just less than 4 years ago, now costs $1.20. I mean, that's significant because a lot of US consumers aren't heavily invested in the stock market. They have their money in savings accounts. They're living paycheck to paycheck. If their wages aren't keeping up with inflation, it's making it really hard to have enough excess money to spend at these businesses. And those are the ones who are, very commonly in the stock market. And so things that we look at investing in, but recently, like I just said, we've pulled out a lot of those just because the consumer is getting pinched and doesn't quite have the dollars to spend to those discretionary businesses.
Yeah, and as you mentioned there, over the last 4 years since the beginning of the decade, inflation's up 20%. That's what we see across whole decades. The 2000 to 2010, 2010 to 2020, we're running at average a little over 20% per decade. We just saw that in the past 4 years.
Yeah, it's pretty substantial, pretty amazing to look at those figures. And it's not surprising why the Fed is so focused on getting that inflation back down to 2%. I think you and I look at this through the Wall Street lens a lot as far as, hey, we need inflation to get lower because then the Fed's going to cut. It's going to make it easier for consumers and businesses to borrow, which is extremely important. But it's also important to realize that people have seen these huge increases in prices. And so every month, every year that inflation, carries over, say, a 3% rate, and if their wages aren't keeping up, it's making it really, really difficult for consumers to save and to spend because, like I said, a lot of their savings are in the bank. And those banks aren't super excited to start paying the Fed funds rate. They're not paying 5%. A lot of typical checking accounts probably still paying pretty much close to zero. And even most savings accounts, you might be getting somewhere around 4%. But those consumers aren't benefiting from that rate increase the way that you would be if you're invested in markets. And so I think it's interesting to see, just going back to it, that split between how Wall Street is looking at things and how Main Street is. And there's a lot of good data coming out for both segments right now, I think, as far as where inflation is trending. We saw that the May CPI report came in much better than expected. Inflation is coming down. And so it gives both consumers and investors something positive to look at going forward.
Yeah, and then as well, the PPI came in flat on core deflationary even. So that's the, purchasing that's more business to business spending, but it's still an important component of that PCE that the Fed looks at. But then, back to the consumer, they're just faced with a whole new price level. It's just a new price level for everything that people aren't used to. And while, year over year inflation is low, it's still compounding on those increases in price that we've seen over the past several years. One point of good news that I want to point out is that, in the CPI and PCE, we've seen really high shelter prices, and that's really kept inflation up. What we've seen in the spot market, in the day-to-day real life current rents, is that they really haven't been inflating very much as of late. There are a few different metrics you can look at, some that we've mentioned in the past, but they're all showing close to that 2% or even less, some in the basis points of year over year rental increase. So it's nice to see the consumer finally getting a break on that, which has been a huge piece in this higher price level and all of this inflation that we've seen.
Yeah, I think that's a great point. A huge macro piece of that is we've had a huge multifamily housing supply come online. So thinking, apartments, condos that have come into the market. And so that supply has helped that rent piece. Of course, the tightness of financial conditions and just the consumer in general hasn't created excess demand for higher rents. So we're getting to what's a better rent price level. And as we've talked about previously, those official government reports on inflation tend to, especially in shelter, because that's the one segment of those government reports, the CPI, the PPI, that lags the actual real market, because everything else is the price that you're paying right now. Whereas rents, they're taking the entire population. They keep polling 7,000 renters every month, and they're polling that entire group. So if you have a 12-month lease, that's only going to change 1 out of 12 leases. And so that data is really slow to update. But like you said, what we're seeing in the actual market right now, very, very low, very modest rent increases, if any increase at all, whereas the data continues to read really hot. And it's been a little bit baffling to a lot of economists, a lot of investors. I think we were all expecting this to really start rolling over earlier this year. It's like we keep waiting month on month on month. When is this data going to come in lower? Because if you look at these inflation prints, the CPI, consumer price inflation, the consumer price index, if you exclude the volatile sectors of food and energy, and then also exclude shelter. So you're still talking about all your commodities, everything related to transportation, all of your, goods spending, and then your services spending as well, but you're excluding that food, energy, shelter. Inflation is 1.9% year over year. And so if you're looking at that official data, and this is what the Fed is paying attention to as well, it's actually not as bad as it seems, because we are all expecting the shelter data to roll over at some point, because we can see what's happening in the market right now.
Yeah. And so that sounds like you're excluding a lot, but the Fed's looking at core inflation already, and core inflation is inflation X food and energy. So, and that's in the low threes. And then you just remove the shelter that we all know is coming. It's just not here yet. And then you get into 1.9%, which is below the Fed's stated goal. And that's a big thing. And I think that kind of goes back to our theory about shelter prices, is that until the Fed does cut rates a little bit, you're really not going to see a whole lot of decrease in like home prices. Rentals have stopped, increasing in price, but home prices aren't really going to see a whole lot of relief until those rates come down and people with those 3% mortgages feel like they can afford, maybe a 5% now, but they're certainly not breaking down the doors to go get a 7% mortgage right now. So once you get more supply going on in the market, then that's how you get prices come down. It's the classic economics of you increase supply, prices drop.
Right. We've mentioned several times on the podcast those golden handcuffs that are keeping people locked into those homes. And exactly to your point, once those mortgage rates drop, I'd say 6% or below. We're still at that 7% plus mark right now. I think you'll have that more supply come online. People will be more willing to move out of their homes. Supply takes up, prices come down or at least moderate. And so you'll see in the spot market, in the real market, those prices moderate even further.
So I think it's going to provide a great tailwind once the Fed starts to cut. And you want to take us through our expectations for that, because we came into this year with the market pricing in, I believe it was 6 cuts for the year. And that has obviously not panned out. And so we've been all the way down to some market participants projecting 0 cuts this year. So what are we looking at, and what is the market expecting right now?
Right. So in May, along with that, with the FOMC, the Federal Open Market Committee meeting, where Jerome Powell gives his whole spiel about where they see rates and where they see inflation, they come out with a summary of economic projections. And that's what you're alluding to with some Fed governors. Everybody gets a dot on a dot plot showing exactly where they expect rates to be at the end of 2024. And a lot of governors, most governors are expecting 2 cuts or looking at 2 cuts. And of course, these are forecasts. They regularly talk about how little this information really means because it's a forward projection and they're all data dependent. They're looking at things month on month. And before the May CPI inflation report, the market was expecting maybe 1 cut this year, but then we got better inflation expectations than we had previously. It looks like we're on a sustained downward path as far as inflation readings go. And so the market's looking a little bit more towards the 2 cut range. That's what I would be inclined to expect, probably starting in September, because the Fed is holding off. They want to make sure that inflation is continuing down to that 2% target. And so they're not going to cut until they're really ready and prepared to see that inflation continue to drop. But, to that point, I think it's important that they start that initiative sooner rather than later, because the longer that rates stay high, it's harder for corporations because they have to renew their debt at higher levels. It's hard for consumers because mortgage prices stay high, and it just creates less lending in the general economy. So you're not witnessing the economic slowing that's already poised to occur because the rates are high right now. And if those dollars aren't flowing now, that's going to lead to slowdown in the future, not today. So the Fed needs to be looking on a forward basis as they make these decisions.
Yeah, and that's been a big criticism of the Fed, is that they were late to hike rates in the first place. And a lot of people are worried that they're going to be late this time around as well, because they're looking at current data, but that current data is all lagged. So it opens them up to the possibility of not seeing the shift until it's a little too late. And along with that, we have 4 more Fed meetings for this year. And I think 2 of those are, then the market's kind of price us in, 2 are kind of non-starters as far as rate cuts go. July, people aren't expecting. as well as November. The November FOMC meeting is days before the US presidential election. And as much as Jerome Powell has tried to distance himself from the political conversation because the Fed is supposed to be its own entity, supposed to not have any pressures, despite, you have Congress people writing the Fed open letters, that kind of defeats a little bit of that purpose of the Fed acting as its own entity. But I think he wants to stay out of the political limelight so much that there's just no way that they would cut days before an election.
Yeah. No, that's an excellent point. I think the Fed, although they are separate, they are a quasi-government entity. I think they are paying attention to that. And so that's really interesting.
Yeah. So that gives you opportunities in September and December for rate cuts. And there's a good chance that one, if not both of those, are going to see one.
And so I think a great way to wrap up this episode would to be give some takeaways for, consumers, our people listening to this podcast right now, investors. You want to kick us off by leading through some of those that we're paying attention to.
Yeah. So to take it back to what we were talking about at the very beginning of the episode is that we're at a new price level. Even though some commodities are actually in deflationary territory, it's all basically net zero in the commodities, and services are still inflating. We're still broad CPI at over 3% inflation. Prices aren't coming back to where they were. They're going to continue to go up from where they are now. They've kind of reset at a higher level after that 20% inflation over 4 years. And they're going to keep inflating off of that at a slow pace, at the pace that we're used to, but you can't really wait for everything to come back down to what you're used to it being, which is not great. I don't enjoy that, but that's just the reality of it, is that things aren't going to go back to the price that you're used to seeing them at. And so it's that being smart with your budgeting and accepting that, planning for these prices to continue. And along with that, things aren't going to go back to the way they were with interest rates either. The Fed's going to cut, whether it's September, December, or in 2025, they're going to cut eventually, but they're not cutting back down to the 0% that we're used to. We're not going to be seeing those sub 3% mortgages. As much as I would love to grab one of those myself, you have to understand that it's coming down, but it's not going to be back where it used to be. I don't know if that means a 5% mortgage is the new norm, give or take from there. But if you're waiting for it to go back to zero, you're going to be waiting a very long time.
Right. It looks like the Fed's neutral rate is going to be closer to 3%, somewhere between 2.5% to 3%. So if you use that as a reference off of, say, mortgage rates were at 3% when the Fed rate was at zero. Well, if the Fed rate's at 2.5%, you add another 3% to that, you're talking about 5.5% mortgage, somewhere in that range, just for some quick and dirty math. So don't expect things to come back down. Unfortunately, I would love to refi at a 3% or sub 3% level, but it doesn't look like it's going to happen. And fundamentally, I think it's healthy for the investing environment to have some kind of yield on debt. It's healthy for banks. It's healthy for fixed income investors. It's healthy for the market in general. Just not as exciting as a homeowner if you're looking to refi at a super low rate. One final thing that I think is really important when it comes to combating inflation, dealing with it on a personal finance level, is to try to get invested. If you have excess savings that may just be sitting in a checking account or a low yielding savings account, you could at least open up a brokerage account, and money markets are earning over 5% right now. So at the very least, do something like that. Typically, equities serve as a great hedge for inflation. So if you have money that's going to be set aside for an extended amount of time, 1 year plus, and can get invested in equity markets, those typically serve as an excellent inflation hedge. They've combated inflation for many, many years, and it's just a great way to build wealth, as we've talked about in some of our other podcasts. But just creating an action plan about helping to build your wealth to combat this inflation, I think can be really valuable as well.
Yeah, agreed. It's all about, positioning yourself as well as you possibly can. And, that can be as simple as, like you said, getting in a money market account, or making sure that you're not just stuck in one of those checking accounts that's earning you 10 bips a year or something like that.
And of course, that's what you and I do on a daily basis. Beck Capital Management, we provide this for our clients. Investing, if investing can be complicated, and if someone needs that assistance, that's exactly what we do on a daily basis. You went back to the planning piece, dealing with higher price levels. Financial planning is a huge portion of that as well. And so, quick shout out there as far as how consumers can really benefit from having an action plan in place to prepare their wealth for the future.
Yeah, definitely.
All right, Hunter. Well, I think we had a great episode today. Interesting to talk about inflation from both the Main Street perspective as well as Wall Street. And I hope that our listeners got some good takeaways from today.